Good morning. I hope you are all healthy and well. It's a great pleasure to welcome you to this highly topical panel discussion on managing technology in finance, global approaches for the digital age. I'm joined by a panel of eminent experts who will provide deep insights into the issues. Technological change has long been a driver of human progress, and the financial sector has been no exception. From the development of double-entry bookkeeping to the introduction of ATMs and modern payment systems, each wave of innovation has left its mark. The age has accelerated these trends. One, detailed data on our activities, transactions, behaviors are now being captured in massive amounts as the Internet of Things, mobile connectivity have exploded around the world. Two, huge increase in computing power applied to this data are making artificial intelligence, or AI, less of a Hollywood movie fantasy. And more, AI systems perform tasks that normally require human intelligence. Three, the news is filled with stories of latest hack of computer systems and resulting loss of service and personal data. These trends are intertwined technologically, but we're only beginning to understand many of the challenges. From the perspective of financial regulators, the key question is how to reap the benefits of technology in terms of financial inclusion, efficiency, risk management, and oversight, while simultaneously managing the financial stability and the integrity risks. In 3 separate and recent papers, IMF staff have found strong complementarities across these issues. They point to the need for adapting policy approaches and regulation to these new challenges, and to the need for enhanced cross-border cooperation to address risks that do not have national boundaries. Shortly, we will explore these topics further with the panel today. But let me now highlight briefly the findings from these 3 work streams. First, on digital economy and data. In today's digital age, data has become a valuable, globally portable good. But moving it across borders requires countries to have coherent policies that build trust. Without global principles for managing data, we could face deepening digital lines between nations as massive data pools become increasingly isolated. It would be especially costly for smaller and lower income countries. The good news is that recently, G7 countries have announced some key principles for cross-border movement of data. And that's a very good start. But there are also dark side. Data can be captured without our effective management by large platforms, creating privacy challenges, monopoly, and ability risks. And this poses challenges to countries to balance individual privacy with needs to protect data from cyber attacks. These challenges have important implications for growth, stability, and the international system, which are at the core of the IMF's mandate and means global cooperation is needed to address them. Today, our panel will discuss how policymakers can address key challenges around data and the digital economy that span financial stability and inclusion, competition, and privacy. Second, on AI and machine learning. The adoption of AI and machine learning technologies in the financial sector has accelerated in recent years and is now far-reaching. Rapid adoption of AI and machine learning in finance can increase efficiency, improve the client experience, and strengthen risk management. They also power the tools used by regulators to strengthen financial oversight and support the implementation of monetary and macroprudential policies. Think of more efficient supply chains or lending to previously unbanked small businesses around the world. But again, these technologies also bring risks, including from capacity, bias, and scope for new sources of systemic risk, including greater interconnectedness. Policymakers will need to confront these issues as they consider potential regulatory approaches. And as we will discuss shortly, the full extent of strengths and weakness associated with these technologies is yet to be completely understood. Third, on cyber risk. The provision of data and digital platforms that connect the world has also increased opportunities for malicious cyber hackers to disrupt sectors that rely on digital systems. One of the undesirable outcomes of the new economy and developments in technology is that it widens the attack surface, particularly within the financial sector, which is at the forefront of data generation as well as technology adoption. In the recent past, supply chain attacks and ransomware attacks have hit the headlines more regularly. Therefore, it is not surprising that risks is one of the topmost concerns of governments, businesses, and consumers. In the financial sector, data confidentiality and integrity, as well as the smooth functioning of information systems, are constantly threatened by cyber attacks. This creates a threat to financial stability and is one that requires more attention. Financial systems are at varying stages of readiness to manage such attacks, and the international response is fragmented. Our panel discussion will cover the latest IMF analysis in this area, which has identified major gaps that, if addressed, could considerably reduce cyber risk and help safeguard global financial stability. Overall, technological advances in finance should be broadly welcome, together with preparation to capture their benefits and mitigate potential risks to the financial system's stability and integrity. But many steps are needed to strengthen domestic and the international policy frameworks on data, artificial intelligence, and cybersecurity, to promote cooperation among countries and regulators, and to build capacity among many countries. I look forward to discussing these issues with our distinguished panelists today. So let me start by turning to Robert first. Let me turn to you first for a perspective from the World Trade Organization. Data, some say, is the ultimate tradable good, and we have seen that trade in data-intensive services has exploded in recent years. Actually, there is one theory that in the future we may not need to trade physical goods. We can just trade data, and 3D printers will help the importers to print. So how do you see the benefits, risks for WTO members from an open flow of data across borders? Are there particular challenges your members face in managing international trade in data-intensive services?
Thank you very much. First of all, for the opportunity to participate in the panel and to review the work of the IMF. Directly to your question, I would have to say that it's a significant challenge for WTO members from a couple of different perspectives. The first major perspective is the wide divergence in levels of development, particularly in the digital space, for WTO members. We know this as the digital divide. So both in terms of digital capacity, but also the development of their financial services sectors are quite divergent across members. And I think that this creates a challenge for a number of members who don't necessarily see an advantage to standardization and regularization and coherence in policy yet, when they feel they have to develop their markets. As an economist, I would argue that standardization and coherence in policy should help them better develop their domestic markets and integrate into this global exchange, and to be able to then gain the benefits of the kinds of efficiency gains one sees from utilization of comparative advantage, importing technology, and those kinds of things. But there's a difference in views among WTO members as to the role of trade and the role of imports in terms of their economic development. Now, we've done research to suggest that the financial services sector is a sector that will significantly benefit from greater integration and coherence in digital cross-border regulation of digital flows. We have a World Trade Report from a couple of years ago articulate what we think the potential impacts on different service sectors will be, and financial services stands out quite strongly as one that would benefit from this enhanced integration and coherence. And so I mentioned that there's this digital divide, both in terms of the capacity, the human capacity, and the physical infrastructure capacity. The view on the role of trade in terms of developing their domestic, help develop their domestic markets and integrate. But there's also just the standard financial regulatory differences in the financial sector, where I think there are significant challenges for developing countries. This is, we think, digital can help in terms of things like know your customer, right? So we think some sort of digital aspect can help validate who it is you're dealing with, as long as there's good security and privacy issues around. But just aligning the domestic regulatory environment to then be coherent with any international commitments or agreements that you agree to can be a real challenge. And we're actually seeing this quite significantly in a current challenge around vaccine distribution, production and distribution, getting the domestic regulatory coherence on a product, given the significant health regulations around it in most countries, creates these problems. And I think we can expect something very similar in the digital and financial space. So there's a lot of work that needs to be done. WTO members are indeed engaging in this conversation. A group of them, 90 of them, are engaged in something called the e-commerce joint statement initiatives. And just to remind folks that at the WTO, you set specific rules. What you do is identify specific principles that then members agree to make sure are reflected in their domestic legislation and laws, so that you get this kind of coherence. And this group is working towards that, and I think they've made progress in a number of areas, but there's still a long way to go. I'll stop there. I hope that's a helpful introduction from the WTO perspective.
Thank you, Robert. That's a very good introduction to this whole topic of data. Catherine, the Competition and the Market Authority in the UK has advanced an ambitious agenda to open banking to increase competition in the financial system. Could you speak to your vision of how open banking could work? Just how important the sharing of consumer data is to support this initiative? Looking ahead, should we think more about open finance and get ready for a blurring of boundaries with many different actors providing financial services?
Thank you very much. In terms of open banking in the UK, this is an initiative that was launched back in 2016, actually, when the CMA, the Competition and Markets Authority, did this big market investigation to look at the effectiveness of competition in the retail banking market. And it found a lack of competition. It found that, for example, banks were not having to compete hard for customers. And part of their proposed solution to this problem was the open banking initiative. And there are sort of two parts to open banking. The first is related to account information, and what it enables is you to allow your data associated with the account, whether that be, for example, your transaction history, to be shared with a third party with your consent, but to allow that third party to make more use of that information for you to make your life easier. So, for example, a very good use case, or one which is proving very popular, is SMEs taking their account information, their transaction history from their bank via a third party, via open banking, and then being able to use that to try and access lending from other providers, because evidently that information is key to being able to test their eligibility for a loan. So the first part of open banking is around this account information and being able to share that data more easily with third parties. And evidently, the sharing of consumer data is absolutely key to take place, but it's done in a very controlled way, in the sense that the data to be shared is specified very clearly, and the third parties who can access the account information are regulated by the Financial Conduct Authority in the UK. So it's done in a very clear way. The other part of open banking relates to payments, and it enables a consumer to initiate a payment from their bank via a third party, and that enables the third party to perhaps enable the consumer to assert more control over their payments than they might otherwise. So if you imagine something like a direct debit, if you set up that payment via this third party and this new technology, then you can, for example, have more control over the frequency of the payment, or, for example, put some controls in place that would enable you to say, well, I don't want a payment to go above, say, $100 without you alerting me and me consenting explicitly to that. So it enables consumers to assert more control over their payment to and from their bank account. In terms of, are we going to see more of this kind of more players entering the financial services space? I certainly hope the answer to that question is yes. I think if you look at the kind of services and innovations that these third parties are bringing in retail banking, the benefits to consumers and to SMEs in the sort of case studies I've talked about are significant. These are good innovations that are creating new functionality, new services that can really help consumers and small businesses. I think the challenge is ensuring that regulation keeps up. And if you provide a traditional financial service, so for example a bank account, it's very clear that you must be regulated to provide that service. And so the regulatory perimeter is very clear. That's the case whether you are a financial services firm, a tech firm, a supermarket, whoever it is. And as more innovators and digital firms start innovating in the margins of these already regulated activities, I think it's clearly for the government and for the regulators to say, well, if this looks like a financial services and it smells like a financial service and it has the same risks as with the financial service, should the perimeter be changed, and should these firms also be caught? And in the UK, our regulatory perimeter has very much kept up, as has the one in the EU, in the sense that they say these account information providers, these payment initiation providers are regulated. But I think that's evidently key if we are going to see this, as I say, really beneficial innovation in this space. It's key that the regulation keep.
Thank you, Catherine. Very interesting experiment in the field of open banking, and we also agree with you that regulation is the key, and we will come back to you later on the further discussion on regulatory framework. AI is a technology with potential, as discussed, for enormous societal and economic impact. It's been deployed in a broad range of sectors and is rapidly changing the financial sector's landscape, bringing significant benefits, also new and unique risks in terms of fairness, explainability, robustness, and impact on financial stability. Anton, from your perspective, given the cross-cutting nature of the technology, could you give us your thoughts on the challenges of putting in place a governance framework that would support the development of AI applications and their safe deployment, particularly in the financial sector?
Be glad to. Thank you for organizing this panel on such an important topic, and I also enjoyed reading the IMF's contributions to the theme. So how to safely deploy AI in the financial sector and throughout our economy is one of the crucial questions of our time. So I want to start with a big picture perspective. What we want our financial sector to do is intermediate savings into productive uses and to allocate risk. A big question is, how can AI systems help us do that? And how can our governance frameworks steer AI in the right direction? At its most fundamental level, AI systems are hyper efficient at maximizing whatever we tell them to maximize. And deep learning is particularly very good with lots of data. So this makes it ideally suited for many financial market applications, because we have lots of data and we have a clear objective that we can program into the systems to maximize. In a world of perfect markets, the welfare theorems, the invisible hand theorems, tell us that if AI is hyper efficient at maximizing profits, it's also hyper efficient at maximizing social welfare. But in the real world, financial markets are unfortunately not perfect. And so AI systems may also be hyper efficient at magnifying market failures and reducing social welfare in those dimensions. Let me look at two specific areas where the use of AI is quite prominent. First, trading. The so-called quant funds are perhaps the area in which AI systems have been around the longest in financial markets, since there's so much money at stake. There is a never-ending race between traders about who can price things better, predict things better, and make more profit. Unfortunately, some of this is socially quite useless. It spends enormous human talent and resources focusing on speed and short-term arbitrage, and perhaps even introduces extra volatility. The parts that are socially useful are those that provide price signals for longer-term investments, and those are very important. But AI systems are not yet particularly good at this, since they rely on lots of data. And we do have lots of data in the cross-section, but not over the time dimension. Our macroeconomic time series are quite short from the perspective of AI training systems. In financial intermediation, there are some decidedly positive developments, but also some risks that should be managed. you have very large data sets that allow you to better predict credit risks and to screen and allocate credit accordingly. And they have the potential to make credit cheaper and more accessible to people and companies that had previously had difficulties accessing it. So from a perspective of financial development, I think there is a lot to celebrate. But let me also highlight two sides that we need to look out for. First, better screening may destroy pooling equilibria. If you can better predict credit risk, it may allow banks to offer better terms to safe clients and stop offering credit to other clients that appear riskier and used to obtain credit. So regulations that forestall the discrimination that may result. Second, AI systems can price credit extremely efficiently in the cross section, but they have, as I already observed in the context of trading, a hard time with the time dimension and the macroeconomic fluctuations that underlie the time dimension. We have only data for a handful of business cycles that each have individual characteristics, and deep learning systems have difficulty modeling those different characteristics and predicting how future macro factors will affect credit risk. The risk is that our AI systems tell us, look, this borrower is really safe because a million other borrowers that looked like her were all really safe over the past 10 years. While at the same time, a gigantic bubble may be inflating, for example, that generates enormous risk. So in the present environment, I view one of the main roles of financial regulators to keep track of this time dimension, which the AI systems are not very good at capturing quite yet. Thank you.
Thank you, Anton. Very interesting observations. It's certainly AI is presenting a lot of opportunities, but also challenges to our development and regulation. We'll come back to later on the regulatory side. Lassa, safeguarding individual data and critical infrastructures from cyber attacks are key to maintaining trust and operational resilience of financial system. This may require greater sharing of information in the public sector on the nature, frequency, and severity of attacks to improve monitoring and mitigation. How could this be done in a way that balances concerns on maintaining privacy and trust in the broader system?
Thank you so much. I think you raised some very important points there, Mr. Lee. I would say that safeguarding individual data and critical information infrastructure would be absolutely key, as you say, to maintain trust and operational resilience. Now, in the area of financial institutions, managing finance, how are we going to do this? I can only give you some examples from my own involvement in the financial sector in India, which is where I have served on the board of a bank in India. And I know the very stringent regulations that do apply, to financial institutions, to fintech, and to banks in India. And the RBI, our central bank, the Reserve Bank of India, is very, very involved in preventing cyber attacks and in building trust in the public, in the users. And they have really, as I said, stringent requirements, which every bank has to comply with, which every financial institution has to comply with. And the anonymization of data is something which, and the privacy of data, the protection of data is something on which they lay great emphasis. I think that, and the other point that they make is for resilience, that there must be a very strong cyber defense system in each institution. And it's actually prescribed what we have to do in terms of the risk management committee cannot essentially have the same composition as the technology committee, or for that matter, the certain roles in the banks are actually compartmentalized in order to prevent this, sort of overlap and, the possible creation of gaps and so on. To the question of sharing of information with the public sector on the nature, frequency, severity of attacks, it actually brings me to the work we've been doing in the Global Commission on the Stability of Cyberspace. Two of our norms specifically deal with the question of vulnerabilities. So I think these are very applicable to the financial sector as they are to other sectors. The first norm which we propounded is that the states should create a vulnerability equities process. And what did we say? That states should create procedurally transparent frameworks to assess whether and when to disclose not publicly known vulnerabilities or flaws they are aware of in information systems and technologies. The default presumption should be in favor of disclosure. In other words, the states have a responsibility to the industry, in this case to the financial sector, to actually disclose the vulnerabilities that they come across in their analysis of what is happening in the sector. The second norm which we propounded was that there must be a norm to reduce and mitigate significant vulnerabilities. And here we're talking to the developers and producers of products and services. When it comes to the financial sector, I think what we mean is that here, in order to preserve the stability of the organization, the developers and producers should prioritize security and stability, should take reasonable steps to ensure that their products and services are free from significant vulnerabilities, and finally, take measures to timely mitigate vulnerabilities that are later discovered and to be transparent about the process. We've all seen what happens when people try to hide the evidence of an attack. It never ends well, because ultimately the news of the attack does come out, people are aware, and it does erode confidence in that institution. So what we are basically saying is that all actors, governments, as well as industry, have a duty to share information on vulnerabilities in order to prevent or mitigate malicious cyber activity. So I think there's two sides to the question that we're discussing. One is you must have a proper central system of oversight, a regulatory authority prescribes what are the standards to be followed, what are the precautions to be taken, what are the protections going to give the end user, the consumer, how are you going to protect their data. And the second part is essentially how do you disclose vulnerabilities in a way that you do not create, that you do not make the financial institution crash, but again, you retain the trust of the user. So it's a difficult balance to achieve, like most things, but I think it can be achieved. So I think I've come to the end of my allotted time, so I'll stop here, and I hope this is of interest to the group, and we can continue this discussion.
Thank you, Lata. That's very informative in terms of what countries can do to mitigate cyber attack risks. We will come back to later on the regulatory and oversight front. Harnessing data, AI, machine learning, and cybersecurity all come together in the financial sector to raise critical issues on balancing opportunities and risks. Singapore has taken several initiatives in all these areas. Could you explain how, as financial sector supervisor, you see the emergence of these issues, and what have you done, and what do you propose to do to help the financial system to reap the benefits of data and technology while mitigating cyber risks going forward?
Hi, good evening and good morning to all. Thank you very much for having me at this panel. Well, as a regulator, we welcome advancements in technology. We want to see our financial institutions harness technology skillfully and safely to serve their customers better. Data and the advancements in its use, including the application of AI/ML, has the potential to benefit individuals and societies. We talked a bit about it earlier. Better risk management on the part of financial institutions, the ability to customize products resulting in better services, pricing, and even include, Anton talked about this, for customers. And we do see this in our markets today. Insurers are increasingly using data from customers' wearables, such as fitness trackers, to incentivize active and healthier lifestyles amongst policyholders. Telematics data are being used to incentivize safer driving behavior. And all these helps to lower collective risk in the system. And customers who manage to lower their risk profiles also enjoy lower premiums. In the banking sector, and Catherine talked a little bit about this, MES worked with the industry and other government bodies to develop a platform called SG Findex to help empower customers or citizens to exploit their data well. And what do I mean by that? Through the platform SG Findex, citizens are able to collate and access all their financial information in one place. So this includes information on bank accounts, deposit and loan balances, your yearly income, your investment holdings, and in the near future, insurance policies. So with concerned customers, banks are also applying AI/ML to this data to provide more holistic and customized financial advice. So what's the result? More holistic, comprehensive and effective financial and retirement plan. So given all these potential benefits, MES adopts a proactive stance in promoting the exploration and the safe adoption of AI/ML within the financial services sector. Let me have 3 broad things that we're doing. First, we regularly curate forums to bring together experts internationally, including from academia, financial professionals, AI practitioners, and investors to exchange views, experiences, challenges, ideas on adopting AI/ML within financial services. And the feedback on these forums have been very positive. Industry practitioners have said that they have been able to pick fresh practical ideas for implementation from these discussions. The second thing that we're doing is to provide co-funding to support institutions and help them overcome financial barriers in adopting AI or data analytics. The third thing, which is also very important that we're doing, is to issue guidance to facilitate responsible and sustainable adoption of AI/ML. The use of data and AI/ML is not risk. We've talked about it earlier by other panelists. Poorly designed algorithms and the use of biased data could systematically disadvantage certain groups of borrowers in the form of higher pricing or even limited access to services such as obtaining credit or insurance protection. So MES released a set of what we call FEAT principles in 2018. It sets expectations for financial institutions through fairness, which is F, ethics, which is E, accountability, which is A, transparency, which is T, in their AI and data analytics implementation. We, however, received that very quickly from financial institutions that the principles were broad and difficult to implement. They asked us, how do we know that we have met your key principles? We therefore embarked on another initiative called Veritas in 2019 to build a framework that allows financial institutions to evaluate their AI and DA solutions against the principles. In January this year, the consortium released 2 white papers on a methodology to guide institutions to assess their AIDA models against the fairness attributes in feed. In the next phase of work, the consortium will provide an assessment methodology for the other 3 feed attributes as well. So this guidance to make sure that there's responsible use of AI is very important for us. Of course, any discussion on AI, ML, data, digitalization is not quite complete without a mention on cybersecurity. And cyber attacks are increasing in scale and sophistication, even as financial institutions' attack surfaces expand rapidly with digitalization of financial services. Now, this is not the new area of risk. And since early 2000s, MES has set guidance, detailed guidance for financial institutions to maintain sound cyber and technology risk management practices. Our belief is that financial services must remain safe, secure, and resilient, and this is a non-negotiable baseline. And over the years, we've updated our guidelines to keep pace with evolving technology and the cyber threat landscape. The most recent updates includes requiring financial institutions to maintain cyber hygiene as a mandatory requirement. We've also issued a set of guidance on cloud adoption, and we've also experimented with the to pilot red teaming and bug bounty exercises as part of their regular cyber testing program. One interesting note to end on is that we are also using AI, ML, and data to augment cyber risk management. So we've used AI, ML techniques such as natural language processing to help us efficiently sieve through the large volumes of cyber news, intel, events from websites and other data sources. This has allowed us to maintain a better near real-time situational awareness and allowed us to respond both individually and collectively as a sector more expediently to cyber threats. I'll end there. Thank you.
Thank you, Xin. It's very interesting. I think MAS is certainly taking a lot of interesting initiatives, and we will continue to observe and learn from your experience. Now, let's spend some time discussing challenges for policy coordination and regulation in our second half of our discussion today. And let me now return to Robert. What are some of the issues you would consider in developing common minimum global principles to govern trade in data, including for financial services? What inspiration can we take, or your members can take from the recent G7 announcement of some key principles?
Thank you. I would have to say that the G7's key principles are valuable. They're more of a political statement than a roadmap. They provide some very high-level expressions of what a regulatory environment should aim to accomplish, but it really doesn't articulate in any detail how to go about achieving those objectives. And I think that's where the devil's in the detail. And I think we heard from Xin that there's efforts underway to try to articulate in specifics in a regulatory environment and almost describe it as a sandbox environment, perhaps, one that evolves to try to engage with the private sector around what works. And that, I think, becomes the challenge at the WTO. So the G7 principles are good. The kinds of principles, maybe with a little bit more flesh on them, the WTO members are likely to articulate in an agreement. But I would say this, I think there's a history at the WTO and its agreements that create a bit of a challenge. I think one that not just in this digital space, but in other spaces that members are going to have to try to address. And that gets to one of Anton's points. We don't have a long time series of data to understand how these systems operate. So I think there has to be an assessment that there are benefits of standardization, but a recognition that there's an endogeneity of regulation and the regulated firms and the regulated activities, and that there's always this tension in the marketplace to try to exploit gaps or voids in the regulatory environment to try to increase profitability. Now, often I would think that that kind of innovation can generate efficiency gains and productivity gains, but sometimes, not too infrequently, it's not used in an efficient and effective way. And it's that tension, I think, that when a WTO agreement gets reached, it'll lay out these principles. Some members are very concerned that those principles are going to lock them in for a very long period of time. Now, for someone who's worked in this environment for many years, I would argue that one has to realize that the WTO lays out these principles and it still leaves it to the domestic regulatory environment to figure out how to apply those rules in a consistent manner domestically. So there is room for regulatory innovation, for that trust but verify, see what's working, what isn't working. But I do think at the international level, even at the WTO level, there needs to be a mechanism to bring that learning back and visiting and updating of international agreements based on the experience that country regulators. We do have some committees, the Technical Barriers to Trade Committee and the Sanitary Phytosanitary Committee, where we bring country level experts around regulatory environments, regulatory agencies in those sectors. And I think it'd be very critical for us to establish something like that in the digital area. Whether or not its focus is specifically on finance is another question for members to decide. But I think we would need to have that kind of ongoing discussion, but then a mechanism to bring that technical discussion back to the political level to potentially revisit any kind of commitments and updating them might be necessary. I'll stop there. Thank you very much for this opportunity.
Thank you, Robert. Catherine, could you speak about lessons from your experience working on the Furman report on digital market? In particular, how should we think about managing the opportunities and risks offered by large platform-based companies? And as the financial services provision, will we need new mechanisms for coordination across regulators with different rates, for example, on competition and on financial stability?
Thanks very much. I'll provide a little bit of background on the Furman review for those who aren't aware of it, but it was a piece of work commissioned by the Chancellor in the UK, chaired, and the review itself was chaired by Professor Jason Furman, hence the name, and it reported in 2018, and the ask was to look at the effectiveness of the rules and regulations, competition rules and regulations in digital markets, and whether they were sufficient to ensure that the UK could reap the benefits of these technologies. And the review looked at the existing competition law, regulation and environment, and concluded that yes, reform was needed in a number of areas. And I'm not going to cover all of those today. I'll say a little word on the sort of particular reform that is being pursued now in the UK, which is the introduction of this pro-competition regulation for digital markets to be overseen by the new Digital Markets Unit with the Competition and Markets Authority. And the purpose of this regulation is to promote competition in digital markets. It concentrates on firms that we deem as having strategic market status, but a very narrow group of powerful firms in the digital economy. And if firms are caught by this regime, three levers. The first is a code of conduct, which would enable the Competition and Markets Authority, the DMU, to be able to impose principles, requirements on firms by this to prevent them from taking advantage of their powerful position. So to ensure that they trade fairly, the consumers and businesses that rely on them for access to their services, but also don't engage in exclusionary conduct to give themselves an advantage vis-a-vis their competitors. Another element of the regime is what we term the pro-competitive interventions, and it will give the Digital Markets Unit the ability to put in place interventions aimed at creating more contestability in the markets in which these digital platforms operate. So really trying to create more dynamic competition and innovation in these markets. So the sorts of interventions that we've spoken about include things like requiring interoperability between services, requiring third-party access to valuable data sets that are necessary for third parties to be able to compete, mandating things like choice screens to give consumers better choice over which products and services they're using, and even going so far to talk about things like operational separation or even full-on structural separation. The last element of the regime is to merger control and allowing the CMA and the DMU to have closer scrutiny over transactions involving these firms. And in terms of the opportunities and risks that the big firms entering financial services lead to, I mean, I spoke earlier about the huge opportunities, and I think we're very, very cognizant of that. But the risks from a competition perspective are very much that the firms take a powerful position that they already have in a digital market and use that to give themselves a leg up or an advantage in these new areas of financial services. And that could be through leveraging the data that they have. It could be by tying and bundling services together. It could be about providing interoperability between their services, but not allowing that interoperability widely. And those are the kinds of behaviours and conduct that we hope to address through this new regime, through the Code of Conduct. A quick word on coordination, because I think the answer to your question is yes, do we need new coordination mechanisms? In the UK, we have this thing now called the Digital Regulation Cooperation Forum, and I know there's a lot of names, but bear with me. And essentially it is a group of us, the CMA, the Competition and Markets Authority, Ofcom, which is our communications regulator, which will be the regulator responsible for policing content on the platforms, so our new safety regime, the Information Commissioner's Office, which is the regulator in the UK which deals with data protection and privacy, and the Financial Conduct Authority, which is the regulator in the UK responsible for financial services. And the idea of bringing these four regulators together in this forum is very much to build greater cooperation and coordination. That includes enabling sort of closer understanding of where our the actions between our different objectives and remits. So, for example, if we are to take an action to promote competition in digital markets, it will allow us to understand more closely the impact that might have on privacy or harmful content on platforms, or resilience, or whatever the other policy objective is, and to be able to work with the regulators to think about, well, can we still achieve that aim of promoting competition in a way that does no harm to these wider policy objectives? So it's it's a work in progress, the DLF, but we certainly think it's the right way to go in terms of having those mechanisms for closer coordination. Stop there.
Thank you, Catherine. Very informative. I think we can also learn a lot from your experience as well. Anton, the evolving nature of AI, machine learning technology, and its application in finance means that neither the users nor the technology providers, regulators understand at present the full extent of strengths and weaknesses of technology. What do you think are the top 1 or 2 issues that we have to be mindful of to avoid unexpected pitfalls, and the role of cooperation and knowledge sharing at the international level?
I very much agree with you that the complexity and opaqueness of modern deep learning systems represent serious challenges for policymakers and regulators. We can see this in the context of financial markets, but also in other areas. For example, the revelations from the Facebook files have demonstrated how hard it is to control AI systems and to ensure that they really do what we want them to do. In some sense, the principle is one of the fundamental insights of control theory. If you develop an AI system and program it to maximize one objective, whether that is financial profits or user engagement, the system may be really good at maximizing that one objective, but to the detriment of all other objectives that human society may have. And that leads to a potential for large externalities. To solve this resulting AI control problem, we first need to be clear about the objectives that we want our AI systems to pursue in order to benefit human society. And these objectives include not only profit, but also financial stability with several dimensions, inclusiveness, perhaps green objectives. Second, we need to include these objectives in what we program our AI systems to pursue. We need to do so in a robust manner. For regulators to properly control AI systems in financial markets, I think that the greatest challenge is to bring the long-term thinking to complement modern deep learning systems that are so amazing in quantifying and predicting short-term risk. At some level, this is just a modern manifestation of leaning against the wind. Our AI systems are very intelligent in one sense, in quantifying risk across the cross-section, but they may miss the bigger picture time dimension. Now, when it comes to the role for international cooperation, I think there are several critical aspects that bodies such as the IMF, the WTO, the BIS can contribute. The first is simply to share knowledge and share experiences. We have more macroeconomic time series if we look across our national borders, although we should not underestimate how much everything is driven by a global cycle. Second, as the speakers before me have already emphasized, running international financial markets using national rules is challenging and creates the scope for loopholes. It requires working together. And third, and this is perhaps sometimes underemphasized, is the role of international organizations in shaping our collective thinking. By organizing events such as the one that we're having right now, you are all supporting the case for reasonable regulation of financial markets to benefit our societies while also curtailing the potential pitfalls of AI. And I think that's a really important contribution to make. Thank you.
Thank you. I very much agree with you. I think international organizations can play a very important role in intellectual leadership and also to provide an important forum for the shaping of our collective thinking on these very important issues. Latha, the sources cyber attacks span many entities, from rogue individuals, organized groups, to state-level actors. At the same time, given the criticality of infrastructure and the financial system exposed to attack, policymakers are acting quickly, including by requiring data localization in some jurisdictions. How do we manage the complex trade-offs of maintaining trust and resilience while balancing individual rights and national security interests, all in a highly interconnected world? What is the scope for cooperation on governance of cybersecurity?
Thank you so much. I think you've raised three very important questions here. Firstly, you raised the question of, the fact that you're getting attacks from many different kinds of individuals, the rogue individuals, the organized groups, the state level attacks, and so on. And you asked, how do we deal with them? How do we react to them? How should policymakers react? Now, I think here we have to touch on the question of the digital divide. It has been mentioned earlier in the discussion, but I think it's important to understand that countries have different levels of capacity to respond to attacks. So one thing which I think is a very practical suggestion is that we need to set up very strong computer emergency response teams, CERTs as they're normally referred to, in every country. This is absolutely essential, because unless you have a strong central CERT, and then from there you go on to also develop sectoral CERTs, because if you don't have sectoral CERTs, they can't go into all the issues in depth in that particular sector. And there can be international cooperation between the CERTs, both in the terms of the central CERTs of each country and the sectoral CERTs of each country. So that would enable a very quick exchange of information, best practices, and so on. That, I think, would be a good way to deal with this question of how do we react swiftly. Those who have the ability to react swiftly can teach countries that maybe do not have the ability to react so swiftly, give them the tools, give them the assistance they need, and share information and best practices with them. The second point you raise is the delicate balance between balancing individual rights and national security concerns. I was myself very concerned about this when I was the Deputy National Security Advisor in India, because when we started to look at our cybersecurity policy, which was published in 2013, was an issue that was very, very prevalent in our minds. And I thought that one way that we could show that we really meant it when we said that we wanted to involve all sectors, all stakeholders, was by setting up a joint working group involving the industry as well. And my hope was that that would then go on to the wider group to also include experts, academia, civil society. I'm not sure to what extent that has happened since I left the government, but I do know that the government still remains open to listening to many points of view and takes their inputs before framing important policies in the cyber sector. So that's the second issue. So I think if you adopt a strong multi-stakeholder model and you take into account the views of all people, not just the national security concern views, but other views as well, you have a chance of coming out with a balanced kind of a nuanced position, let me say. Finally, on the question of what is the scope for global governance, I think all of us here are aware how much is happening in the area of global governance. I'd first like to talk about initiatives in the UN, in the United Nations, between the open-ended working group and I believe now the new open-ended working group, which is its mandate or is about to start its mandate, is chaired by Singapore. So this would be of interest to our representative from Singapore. The UNGG itself, though that has not been as successful of late in coming out with specific recommendations. And many countries feel that the open-ended working group is a more open mechanism. It's not a small club of countries, but everybody can participate. So I see more scope for the open-ended working group. You have the high-level panel recommendation and the roadmap set up by the UN Secretary General. You have organizations like UNIDIR, which are specifically focusing on cyber issues. You have the Global Forum on Cyber Expertise. You have, unfortunately, the Global Conference on Cybersecurity no longer exists. Really, it hasn't met for several years now. But you have the Internet Governance Forum, which is emerging as a very important area where, again, with a multi-stakeholder model, many countries are cooperating. And that directly derives its mandate from the VICES and the Tunis Agenda. You have initiatives like the Paris Peace Forum, and you have many excellent groups originating in the private sector, such as the CORD, the Charter of Trust, and the Cyber Peace Institute. You have think tanks doing excellent work. I would mention specifically Carnegie, CSIS, the Hague Center, Strategic Studies, and East-West Institute, which, while it's handed over its work on cyber to other agencies, has done some very remarkable work. And of course, we had our own global commissions, which I've mentioned. One, the Carl Bildt Commission on Internet Governance and the GCSC. And we have think tanks in India that are doing tremendous work on technology and technology policy, including the Observer Research Foundation. But I think I'm just giving you this whole alphabet soup, essentially, to point out the huge importance of international cooperation, that it's not something that people have given up on. A lot of people would argue that now it's time for a small group of like-minded countries to come together. But I think there are enough global initiatives that while, yes, we can have regional organizations that are very strong, who are doing excellent work. I think of the EU, I think of ASEAN, I think of the OSCE, I think of AUC, the African Union. But I think to give up on global governance would be a mistake. I actually think there is scope for global governance, and I would really say that, particularly on norms and on accountability, if we don't continue to discuss and we don't continue to come up with mechanisms, really speaking, you cannot really have a stable, safe, open, and secure internet or any kind of cyber system, including the new emerging technologies. So I would really make an appeal that we should continue to work on global governance. Thank you.
Thank you, Nasa. I very much agree with you. I think we should never give up on the potential of a stronger global governance on cybersecurity. We at the International Monetary Fund, we are also putting cybersecurity as an important part of our work on financial stability, including our surveillance and capacity building work. Let me come back to Heng-Xin on how regulation needs to adapt to the many transformations and challenges the global financial sector is facing. From use of individual data and to AI, machine learning, to DeFi, digital assets, to open finance, big tech in finance, to concentration in cloud services, many issues arise. What should regulators and supervisors do to ensure the brave new world is also safe and stable?
Thank you. So what can regulators do? Regulators are the catch-all, right? When it comes to problems, they do. So it's a wide range of very exciting topics, and I think it will take hours to discuss the nuances of. Perhaps let me share a few general guiding principles that underlie our approach to monitoring and responding to emerging trends within the financial services sector. The first principle is same risk, same treatment. In general, financial products that pose the same risk should be subject to the same rules. This ensures a level playing field for all financial services providers and helps to avoid regulatory arbitrage. For instance, digital securities tokens are insubstantial securities. They are therefore subject to the same securities laws as traditional securities and are similarly regulated under the Securities and Futures Act. Digital payment tokens, on the other hand, are regulated under our Payment Services Act. The second principle that we try to adhere to is what we call beware the potential regulatory gaps. And I think Catherine pointed this out earlier about things falling between the regulatory perimeters. New financial innovations and technologies may introduce new or heightened risk concerns. In my earlier sharing on the use of AI models, the risk of systematic discrimination was a new risk concern. We therefore issued new guidance, the FEED principles, to address this concern. So sometimes new guidance is necessary. In the area of cloud adoption by financial institutions and their vendors, concentration risk is becoming a heightened risk concern. Let me explain. There are just a few major cloud service providers out there in the market today. So a service outage by one major cloud service provider could potentially lead to disruption of critical services belonging to multiple financial institutions. At the same time, we notice that financial institutions face significant challenges in engaging major cloud service providers to comply with their security and resilience standards. Financial institutions just do not carry the same clout to influence cloud providers in the same manner that they are able to with smaller service providers. So in time to come, the question is, will cloud service providers become too big to fail for the financial industry? We're exploring with like-minded regulators and partners how to build resilience in public cloud adoption by financial institutions. One potential solution, of course, is to establish a collaborative oversight forum similar to the SWIFT oversight forum that we're familiar with. This will allow supervisory authorities to collectively engage major cloud service providers on common supervisory or regulatory issues associated with financial institutions' adoption of public cloud services. We can also consider creating a financial services cloud. We call it the FinCloud, a cloud that meets a certain baseline standards of cybersecurity, data protection, and systems resiliency. And this can complement the cloud oversight in the earlier proposal, because it helps to make clear what baseline expectations are in terms of configuring. It will also limit the scope of oversight that financial services regulators would have to engage cloud service providers on. To be alert under the second principle of beware, being aware of regulatory gaps. So to be alert to emerging or heightened risk areas of concern will require a very good understanding of fintech and technology trends and developments. Hence, significant investment in this knowledge acquisition is also needed. The third principle that we try to adhere to is proportionality. The level of regulation should be proportionate to the materiality of the risk, and regulation should definitely not front-run innovation. As regulators, our protective instincts generally compel us to issue new rules when we come across unfamiliar technology or instruments that pose a risk to consumers. However, we're keenly aware that innovation can bring benefits. So for instance, DeFi has the potential to bring benefits to the economy players. So without the need for intermediaries, for example, smart contracts executed on decentralized exchanges could potentially reduce the cost of finance. Real-world assets also now can be tokenized as smart contracts, allowing rights of ownerships of these assets to be transferred seamlessly, improving price discovery, liquidity, efficiency. So in order not to stifle innovation and potentially derail the adoption of useful technology, there is some merit to intervening with regulation only when the risk warrants it. So our approach towards digital payment tokens is one such example. MES does not encourage retail investment into cryptocurrencies because the prices there are not tied to any economic fundamentals and subject to speculative and sharp swings. Investors can potentially suffer significant losses. However, currently the usage is still low, and we have thus relied on predominantly consumer education and public advisories to warn retail investors of the risks of cryptocurrency investments. However, we have also reserved powers in our Payment Services Act to allow us to impose additional measures on digital payment token service providers if this becomes necessary in future. So to wrap, we do need to strike a delicate balance between encouraging technology and innovation and mitigating associated risks. MES will continue to monitor technology developments in the financial services sector and adapt our regulations accordingly. On the global level, though, I must leave with this note. We do urge regulators to work closely together to address cybersecurity risks. As many colleagues pointed out earlier, close collaboration is very much needed in this space. Thank you.
Thank you, Heren-Shin. I think you remind us a very important trade-off. Among all the difficult trade-offs is the trade-off between encouraging innovation on one hand and also mitigating the related risk on the other hand. I think many countries are grappling with this difficult trade-off right now. I think we are getting close to the end of our discussion. Time is short. There are so many important issues. Let me briefly summarize our discussion. I don't think I can do justice to all the important points, interesting observations made by our panelists, but I will try. As highlighted by the 2018 Bali FinTech Agenda Declaration, technological advance in finance should be broadly welcome, but this must be accompanied by necessary preparations to capture their benefits and reduce potential risks to the financial system, both in terms of integrity and safety. Many steps are needed to strengthen domestic frameworks and also international cooperation on data, artificial intelligence, and cybersecurity. The work is still needed, a lot of work is still needed to help solve coordination issues among regulators and also countries, and to build capacity within regulatory agencies. In our view, policies should focus on 3 areas. First, they should clarify rights and obligations over data and encourage data sharing. This will allow markets to function efficiently, as well as promote competition and innovation, while protecting privacy. Second, more efforts are needed to enhance regulatory framework and supervisory practice to promote the safe deployment of artificial intelligence and machine learning systems in finance, and address cyber risk. This will help ensure that emerging markets and developing economies do not fall behind. And finally, these policies at the national levels should be underpinned by strong international cooperation and knowledge sharing. Globally agreed approaches will help to strengthen and sustain the global digital economy, as well as prevent a widening of the digital divide between advanced and developing economies. These are all challenging issues, especially on coordination, global cooperation, because they span many countries, sectors, and regulators. We need to begin somewhere, and finance is a good place to start, given the strong institutional frameworks already in place. And standard-setting bodies, including FSB, BCBS, and the international organizations like the IMF and the World Bank, will continue their efforts to assist in charting the course forward. I want to thank our panelists today for your insightful discussion, and we hope that we can continue our dialogue in the next months and years. Thank you very much. See you next time.